Welcome investors! Today I want to talk a little bit about age-related investing, which means that when you progress in life, you should have a different percentage of the stocks and bonds in your portfolio than 10 or 20 years when you were younger. There is a golden rule where you subtract from 100 your age and then you come up with the number of the stocks which you should hold in your portfolio. So for example, if you are 50 years old, you subtract from 100, you subtract 50, and then 50 is the 50% which you should hold the stocks in your portfolio. If you are 70 years old, from 100 you subtract 70, you should hold 30% of the stocks. Basically, the rule goes towards direction of having more secure and stable portfolio, having less stocks and more bonds. Me personally, right now I hold 100% of my holdings in stocks. But I'm planning to transfer some of those stocks to index fund which holds the stocks, S&P 500, of course, Vanguard index fund. Right now, roughly, I hold around 45% all of my holdings within this index fund. I'm not planning to have transferring some of those funds towards bonds like this golden rule recommends, because I think that the index fund is as stable as the bonds. And even if the index fund and the generally stock goes down, then eventually after a couple years the stock is recovering. So this rule I'm applying, but without the stocks. Those all funds I'm going to transfer towards the index fund, and especially the stocks which I purchase and I considered very risky. Years ago, I bought some stocks of gold companies, gold mining companies. Those companies did very well, so eventually I'm planning to transfer them to S&P 500 index fund. The same, the uranium stocks, Energy Fuel, the company which is actually the winner in my entire portfolio. I own 47,000 shares of this company, and it's around 300% up, and eventually I'm planning to transfer those funds to S&P 500 index fund, but I'm going to wait at least 5 to 10 years more, because I'm hoping that Energy Fuel's shares are going to go to 100 per share. And there are also some losers in my portfolio. Cannabis industry, the Aurora, it's 97% down. Luckily, I invested only $20,000 into the Aurora, but it's down, it's gone. Probably it's never going to come back. All the rest of the companies from cannabis industry also are down, and that was the worst and the biggest mistake which I did so far. So eventually those companies I'll liquidate and also transfer the funds to S&P index fund. I'm not going to transfer these funds towards the bonds like this golden rule recommends. Some of the companies and other companies which I own, like Google, recently I bought Amazon, if they do very well, I'll keep them. But if they don't do really well within next 5 to 10 years, I'll liquidate them and put them into the S&P 500 index fund, because that is my safety net. S&P 500 index fund. No bonds. I don't want to have any bonds. I don't want to have anything to do with the bonds. I deeply believe that S&P 500 index fund is the place to be, because you are diversified. you are within 500 companies, the biggest companies, the biggest dividend payers. So basically, if this entire basket of companies goes down, it's probably the end of the world for the stock market, for bonds, for everything else. So this is my take. I'm deeply committed to S&P 500 index fund, and probably from now on I won't be buying any individual stocks like I was buying in my previous years, even big stable companies. I'm going to be dumping all the money, all the extra money towards S&P 500 index fund. That is my safety net. Okay, thank you so much for watching this quick video. I hope you stay healthy and well. And of course, like always, if you like the video, give me a thumb up and share the video all over the social media, and subscribe to the channel for more videos coming in the future. Thank you so much for being with me here. I appreciate your time. Stay healthy and well.